And so the first thing that I want to start with is to look at the state of debt in Kenya, so to speak. Kenya, as some of you might be aware, is a nation where we have a GDP of about 3.4 trillion Kenya shillings. And out of that 3.4 trillion shillings, the public debt, the size of public debt, stands at about 2.3 trillion. So you can imagine it is already quite high. This comes to about 57% or thereabouts. And so arguments that have been going on in the press have been around the size of our debt as it relates to the proportion of GDP vis-a-vis the sustainability of that debt. And so if you compare to other countries, the African average of debt to GDP ratios is about 35%. But you have to remember that some African nations have actually have debt waivers under the highly indebted debt countries. So HIPIT initiative by the UN and the IMF. And some of these countries have also, not borrowed as heavily as Kenya has borrowed. So in terms of comparisons between the Kenyan situation and the African average, we are certainly far much above the 35% that is average for Africa. But really, economists have often argued what is the sustainable debt level. And the consistent figure that is often put there, though it's not, there's no consensus on it, is that it should be at about 70%. And so studies have shown that beyond 70%, given certain limits of economic growth, it will actually then begin to harm your economy. Now, these figures I'm giving as at last year, June 2013, or rather September 2013, and they are sourced from the Central Bank of Kenya. Now, as you remember, this year we've had now significant developments. The first, of course, is the Chinese arrangement which we've gone into, where we've borrowed 327 billion. And then we've had the floating of the issue of the Eurobond, which is also another over 300 billion shillings. So essentially, we've added about 50% of our debt to the position where we are at in September 2013. So the situation is now perhaps much higher. So it might not even be 57% of GDP. It can actually be close to 70 or even above 70% of GDP. So that's important to bear in mind because when it comes now to looking at the issue of debt sustainability, to what extent can this borrowing have an effect on our domestic economy? We have to look at how the composition of these debts. And so if you come down to breaking down this debt, we have two types of debt as already been mentioned. We've got external debt and then we've got domestic debt. Of the 2.3 that I spoke of, domestic debt is about 1.2 trillion. So these are instances where the government comes to the market through open market operations, and they borrow from fund managers and investment managers based in Kenya. And so this is about 1.1%, and so therefore constituting about 57% of total public debt. So that means that foreign or external debt is at about 0.8 or 0.9 trillion. So if you take the two already, it's quite high. And so when we're looking at impacts, we know the biggest mechanism for us to be affected by debt is through the interest rate. The most obvious or the most direct influence is through the domestic borrowing which government often does, before we even look at external financing. So if you look at domestic borrowing, we have, the government typically issues securities, treasury, bonds, and so on, that are either denominated in 5-year or 10-year or even 20-year currencies. Now, I learned a few days ago, this week, the government was took to the primary market, which is essentially an IPO of bonds. So the government took its 5-year and 20-year debt instruments to sell to members of the public. And the yields that they attracted actually increased. The quotations I'm getting are that the 5-year bond coupon rate has a yield of about 12%, which is previously the yield of a 10-year bond. And the 20-year bond has now a yield of about 13%. And if you look at the market averages, they are actually quite close to those annual yield rates. So what it tells us is this, that in the first instance we have got two effects. The price, because the yield is really essentially a price. It's what people pay, or what government pays back to the people for lending them the money, whatever they borrow. So what it tells us is that we are paying for the 5-year bond, coupon one, we are paying the price of a 10-year one. So there's been an escalation, and in fact it rose by about 106 basis points. So essentially interest rates have already gone up, and this is last week, so it could be because of the Eurobond that was floated, but I'll come to that. Then secondly, if you look at the 20-year yield rate, the yield rate together with the market average is at the same level. It's actually the same point, the same price point. Essentially, it's showing us that, you know how the markets work, bond markets work is, you've got traders who go in and buy the primary document. So they buy the actual security. And then, so this is bought at the primary market. So once they buy it, they go and sell it in a secondary market so that they can make some small monies on top for their clients and earn some commission. So usually the secondary price, the price of the secondary market is usually significantly higher than the price of the primary market. But the situation as we have it today is that the primary market price, which is the yield of that coupon for the 20-year bond, is about 13.7%. And yet the market average price, which is the price of the secondary market, is the same 13.75. Essentially meaning that that one event has wiped out the secondary market, because now the trader cannot make any margin. They'll go to the secondary market and it's the same price. So we essentially, by that one, whatever, we've killed the secondary market. So we expect traders to not buy 20-year bond, or they will buy and keep. They'll not buy for trading in the secondary market. So already we are beginning to see the implications of the debt. We are seeing a rise in interest rates. And so to connect that now with external borrowing, you know, the major departure point that we have today is that external borrowing has been through IMF and development partners. So these are concession loans. Now, last year we took out syndicated loans, which are essentially just non-concession loans. And the figure that Treasury has given us is that we took out loans of about 600 million. Okay. Now this 600 million was supposed to be for meeting our recurrent expenditure and some of our urgent payments that we needed. And this loan was due by, I think, September last year. We need to repay off this syndicated loan. And we could not pay it. The reason being is that we didn't have enough liquidity to make those payments. And so for that reason, the Eurobond that has been floated, part of the proceeds or part of the monies collected from that Eurobond is meant to pay off these syndicated loans. Essentially what it means is that a syndicated loan is already a loan that you're getting at a higher interest rate, which is non-concession, and these are between 4 to 7%. And so already it's expensive. And then we're going to the Eurobond, where we are also raising money, and these are also non-concession. So again, the same interest rates apply. So essentially we are borrowing money, expensive money, to come and pay off other expensive monies. Now obviously we have very few options at this point, because, and that's why we're borrowing, otherwise we would not be borrowing. But what it implies is that we are worsening the situation for ourselves when it comes to the signals that we are sending, particularly in our money markets and in our stock exchange and securities markets. So that is an important point to bear, because we, in addition to having borrowed expensive money, we've exposed our domestic economy to forces that we have less control of. As was stated, we have floated this in the international markets. And international markets, you have your coupon rate for which you pay, but the coupon rate then develops a secondary market. And that secondary market acts or is manipulated by individuals who are informed by tastes, preferences, emotions, information, and actions that our government takes. So it means that if, the same argument that was being made, if we are not prudential in the management of our affairs, the premiums that are going to be charged on us, particularly in the secondary market, will be much, much higher. And the effect that that has is one of two. The first thing that we have to recognize is, domestically, we have a benchmark interest rate, which is the central bank rate. Now, every month, the central bank sits down and says that, look, because inflation is at a certain level and employment is at a certain level, we want to either raise or lower or maintain interest rates at a given rate, so that banks can then get the signal for how to then set their own lending rates that eventually the individuals and private firms can borrow. Now, that effect is actually transmitted all the way to our own stock exchange, to our own money market. And therefore, it displaces the central bank rate as the key benchmark rate for determining the price of credit in Kenya. And so essentially what we will have done, because already the primary coupon rate is high, the secondary coupon rate is likely to be high, we will have even higher interest rates in the country. And so that's a very big danger for which we've walked ourselves into. And so it is prudent for us to actually seek answers to the questions that are proposed here. To what extent are we managing, are we pursuing prudential and financial management? The other thing that I want to mention is when it comes to foreign exchange, because that's the other mechanism by which we have impacts in terms of borrowing. This Eurobond is denominated in foreign currency, which is the US dollar. And essentially, the government will be getting an influx of forex from the sale of this Eurobond. And obviously, this is going to affect the position, Kenya's position in terms of the foreign reserves held by the central bank, as well as the central bank, or rather the foreign exchange rate level for which the Kenya shilling trades with the dollar. Now, there are two effects that might arise. There could be a weakening of the shilling, because really demand for the dollar will go down, because now you have more dollars, you have increased supply of dollars, so demand for the dollar will go down, so you've got an appreciation of the shilling. So if that happens, then it makes our exports much more expensive to the world. So the effect of that is to contract export value expectations. On the other hand, if these foreign reserves are therefore, or rather, if the money earned from these Eurobonds are actually used to boost the reserves that we have at central bank, and therefore not release it to the market, it could actually constrain the number of, or rather the supply of US dollars in the market, and therefore leading to greater or heightened demand for US dollars, leading to depreciation of our currency. And if that happens, it means that basically our export position will improve, because really our exports will be cheaper in the international market. But I think this is unlikely to happen, simply because of we are getting a huge influx of forex, and therefore leading to what I've discussed. And so, really, if we apply ourselves to back to this debt composition issue, the question then that central bankers do is they perform what are known as stress tests. So essentially, they look at, they have, various targets along for various indicators, debt indicators. And therefore, they make assumptions that what if our GDP growth dampens or reduces by this much? What kind of position would we be in terms of debt, and how would it impact our sustainability of our debt? And the one that I've seen, the stress tests that I've seen, these were done in September last year. So they exclude the 327 billion bond from China and the Euro bond. Actually indicated that one particular indicator went off target. So essentially there was a fundamental weakness in the debt position, in Kenya's debt position. So it tells us that at that time, even with less debt than we have today, we needed to take remedial action. And so that perhaps is a big thing we need to underline, because that was only one indicator of four. All four have to, for you to be sustainable, all four have to check off. So now our situation we've increased our debt by about two-thirds, because if you take 300 billion from the Euro bond, 300 billion from the China's loan, it's quite significant. So what comes to my mind is that if we do those stress tests today, that particular indicator might actually be worse, or even more indicators will not meet their targets. And the problem is, as someone who sits outside government, we don't have this information, we don't have the most current up-to-date statistics on those indicators for us to perform those stress tests ourselves. So the other thing that comes into mind is there is an information deficiency right from the start around this whole debt issue, which we should also be raising. We don't have enough information in the public to consider the options that are available for government, and for us also to be able to also help government in shaping their own policy reforms that we want to see. So with those few remarks, I think I'll stop there. But really what I did is just restrict myself to the impacts, and I've excluded everything that has been talked about.